All right, we're doing a special edition of an LTC Tree video here today. I'm Drew Nichols, here on vacation, but still making a YouTube video just because of the timing of this week. We've had some movement in the markets over the last couple days. So I'm here with my partner slash cousin, Derek Wilkins. Hey, Derek.
Hey, Drew, how's it going? It's also market timing, but it's also you got that amazing background we wanted to get on the YouTube video, for being honest.
Yeah, I'm up
Where are
here
you?
I'm in South Carolina at Lake Hartwell. And yeah, so currently there's a hurricane in half of the state of South Carolina, and they were getting
Hmm.
like 20 inches of rain. But up here, because of that, it's like blue skies and low humidity. It's just amazing. Like, the tale of two cities here.
Low country is the hurricane, or high country where you are?
The upstate
Clear
is the
blue
best part of
skies.
South Carolina. So anyway,
Yes.
yeah.
Yeah.
Let's talk a little bit about when we get into moments like we're in right now, where the markets, are not just going straight up like they have been doing recently. It gets people thinking a little bit.
It does. I fielded a lot of calls from nervous clients who basically their advisor has been like a permabull, we call them. Hey, the market's going to go up forever. To your point, don't worry about getting any type of insurance products because you'll just self-insure. The market's always going to go up. But however, the market doesn't do that. You can look at the past 25 years, and there's been five instances. We had a 2007, 2008, 2012, 2020, 2022, where the market was down 30% or more. There's a couple of 50% moves in the market. So if you need your money when the market is dropped, it's not a good time to sell. So that's kind of the point. You don't want to have all your money in the market. You want to have just a small portion, maybe 20% of your assets in something with guarantees, and that's what we're going to talk about today.
Yeah, and we're both economists by training. We both have economics degrees, so we like to talk and think about sort of the macro issues. And over the last, 25 years, all of those drops were immediately responded to by the Federal Reserve with big interest rate cuts. We have to wonder, how long can the Federal Reserve continue to just drop interest rates anytime they need to, with all the debt and everything we have? It may not always be guaranteed to bounce right back like it has tended to do. So we have to be cautious of having all of our money in the market. And I think that was what kind of inspired us to make this video, is just to get our clients thinking and just to discuss the thought process of some of our smarter clients about why they move, like you said, a portion of their money into something that's more secure. So let's get more specific. Let's talk first about hybrid long-term care plans. Let's run through how those work.
Yeah. So hybrid long-term care insurance, it's basically if you need long-term care at home, like for home health care, assisted living, nursing home, that can be 100 grand a year easy. So having to draw that out of your portfolio, paying capital gains taxes, maybe, have them draw it out and down when the market's down, that's not a good idea for a lot of people. So it's a product to where you can set aside a small portion of your assets, maybe 10, 20% of your assets into this product. It immediately gives you probably a 1-to-4 ratio. So if you put in 100K, you got 400K with most clients from day one, tax free. Also, that 400K is going to grow 3% compounded. So in 20 years, everything's doubled. So now you're at a 1-to-8 ratio if you need long-term care. Now, if you don't need long-term care, they'll give you your principal you paid in with a little bit of interest back, tax-free at death.
Yeah, as a life insurance benefit. So let me just say that again for someone who's listening. They can take, and we encourage people to do this when the markets are frothy like they have been. Take a look, take some chips off the table, say $100,000, put it into a hybrid long-term care plan. If you never need long-term care, all of that money for most people, plus a little bit more, is going to come back in the form of a life insurance. But more importantly, that 100,000 could easily turn into $1 million or more of long-term care benefits down the road. This is not for people who need long-term care now. This is for people who are in their 50s, 60s, maybe even their 40s, 50s, 60s, who are planning ahead. You could take $100,000 out at an all-time high in the market or close and get nearly $1 million of growth on that money for long-term care benefits, tax-free. That's the key.
Yeah, and it's just there's that rule of 100 that we've spoken of in the past. For every age that you want to have that percentage of your assets in guarantees. because the Federal Reserve's been monkeying with interest rates, keeping them near zero for the past 15 years up until recently, a lot of people have way more stocks in their portfolio than they probably should, historically speaking. So we're not talking about taking out, the majority of your assets, putting in this product. We're talking about, money that you might have been using, put it in a CD, or maybe you're putting it in a low performing bond, attaching some guarantees to your portfolio. And for those who want to self-insure the risk, we do have some people who, it's higher net worth, but they, at the same time, want a little bit of a guarantee. There's what is called equity index annuities. And those are, because those are kind of tied to the federal funds rate, which is at an all-time, 25-year high. The fixed index annuity market has been as good as it's been in a quarter of a century. And what those are is you basically take the same 100,000, give it to an insurance company. There's a dozen out there that have decent products, and they'll allow you to index it to popular indexes like the NASDAQ, the S&P. There's name brand funds that you can put it in. And the insurance company on the other side, they'll give you a 0% floor in case the NASDAQ goes down. For the year, you get a 0% return. If it's down -20, you get a 0%. So they protect you on the downside, but then they'll allow you to participate in the gains on the NASDAQ. And I know this is kind of long-winded, but I just read a quote for a gentleman the other day in that NASDAQ product. Obviously, the past doesn't predict the future, but if the past 10 years repeated in some form or fashion, $100,000 in 20 years would be worth about $800,000. So it's not guaranteed to do that, but that's just, but on the flip side, if the NASDAQ was down 0% every single year for 20 years, he'd have about 130,000. So there would be a bare minimum guarantee if the worst thing happened. So that's what we're talking about, just attaching some guarantees to your portfolio.
Yeah, and those products also do have the option for a long-term care rider. There's a lot to talk about. We've got some other videos on the annuity side of things, but really the overall theme is this is a sort of a reminder that we do need to rebalance our portfolios after we have really big bull runs in equities like we've seen. And two of the safe places that people do a part of that rebalancing to are hybrid long-term care plans if they're healthy and in their 40s, 50s, or 60s. And then the equity index annuities, which are a little bit easier to qualify for. They have very limited health qualifications. It's more financial qualifications.
Yeah. Well, we're LTC Tree. We work for you, not one company. We work with every single company out there. So we help you shop the market and get the best deal for long-term care insurance, hybrid long-term care insurance, life insurance, fixed and index annuities. So if you want to learn more information, just think of us as we're your retirement planning specialist. This is what we've been doing. I've been doing it for a quarter century right out of college. So Drew's been doing it for probably 20 years. So we got almost 50 years of retirement planning specialists working for you.
Yep. And one thing that we really always like to remind everybody, we don't just work with one company. You mentioned there's a dozen companies. We really like to show a variety of options to help people pick the best option on the market. So, hey, thank you all for watching. Derek, thanks for chatting with me, and let's wrap it up.
See ya.
Bye-bye.